Warsaw's currency gamble. It started as a calculation meant to protect growth, a decision framed as pragmatic rather than bold. Exchange rates were shifting, capital was restless, and Poland stood at a crossroads between stability and acceleration. In Warsaw, officials chose to lean forward, believing they could manage the risk. What followed would test how far confidence can stretch before it snaps. To understand why Poland embraced a currency strategy that unsettled markets, we have to return to a moment of transition. The economy was expanding, investment flowed in, credit demand surged. But beneath that momentum lay vulnerability. Much of the growth depended on foreign capital sensitive to rate differentials and perception. Managing the currency became more than a technical exercise. It became a lever for economic direction. The gamble took shape through policy signals rather than declarations. Rates were held lower than expected. Intervention was implied, but rarely executed. The message was subtle but clear. Poland would tolerate currency weakness to support competitiveness and domestic borrowing. For exporters and borrowers, the move felt supportive. For markets, it introduced uncertainty. At first, the strategy worked. The currency adjusted gradually. Growth held. Capital remained. Confidence appeared justified. Officials pointed to resilience as proof that the balance had been struck correctly. But currencies do not respond to intentions alone. They respond to thresholds. Inside banks and corporations, behavior began to shift. Borrowing in foreign currency increased. Hedging was delayed. Assumptions hardened around continued tolerance for depreciation. What began as policy flexibility slowly shaped private risk-taking. The gamble was no longer confined to Warsaw. It was spreading through balance sheets. Early warning signs appeared in trading patterns. Volatility clustered around announcements. Liquidity thinned at the edges. International investors shortened horizons. None of it dramatic, all of it cumulative. The currency was no longer just a reflection of fundamentals. It was a test of resolve. Officials watched closely, confident they could adjust if needed. But adjustment in currency markets is rarely neutral. Signals must be precise. Timing must be exact. And credibility, once questioned, demands proof rather than reassurance. As pressure continued to build, one reality emerged. Poland was no longer managing the currency alone. The market was now participating in the decision. And when markets join a gamble, the stakes change quickly. The market's participation changed behavior almost immediately. Traders began testing boundaries, pushing the currency lower in short bursts to see how authorities would respond. Each movement was small, plausible, defensible, and each one mattered. Silence from policymakers was read as tolerance. Tolerance was interpreted as invitation. Inside Poland's financial system, exposure quietly accumulated. Corporations extended foreign currency borrowing to reduce costs. Banks facilitated it, confident that gradual depreciation would remain manageable. Hedging programs lagged behind reality. Treated as optional rather than essential, the gamble deepened not through recklessness, but through normalization. Policymakers faced a narrowing corridor. Intervening too early would contradict their own signals and risk credibility. Waiting too long would allow imbalance to grow. Currency strategy depends not only on economics, but on psychology. Once the market believes it understands your limits, it will move directly toward them. External conditions worsened the tension. Global risk appetite shifted. Capital flows became more selective. Emerging market currencies faced pressure as a group. Poland, once differentiated by confidence, was now evaluated comparatively. Investors did not ask whether the fundamentals were sound. They asked whether the defense would hold. Volatility increased in uneven waves. Not enough to cause alarm, but enough to change pricing behavior. Bid-ask spreads widened. Liquidity thinned during key hours. The currency no longer moved smoothly. It jumped. Each jump amplified uncertainty inside balance sheets that had assumed gradual adjustment. Inside Warsaw, debate intensified. Advisors warned that continued ambiguity could invite speculation stronger than any intervention. Others cautioned that acting would validate fears that the situation was worse than acknowledged. The window for costless correction was closing. Banks began reassessing risk internally. Stress scenarios that once seemed remote now appeared plausible. Foreign currency liabilities were recalculated against sharper moves. The gamble, once theoretical, began appearing in numbers that demanded attention. Markets sense a shift. Confidence does not break suddenly. It tightens, like a spring under pressure. And as Poland's currency hovered near levels no one had wanted to test publicly, the gamble approached its decisive moment. Because in currency strategy, hesitation is itself a signal, and once hesitation is priced in, control becomes far harder to reclaim. The breaking point arrived not through collapse, but through acceleration. A sudden shift in global sentiment pushed the currency beyond a level that had quietly anchored expectations. The move was sharp enough to force recognition, yet not large enough to be dismissed as noise. What followed was a rapid repricing of assumptions that had taken years to build. Inside banks and corporations, the impact was immediate. Hedging programs were activated late, at worse prices. Foreign currency liabilities swelled on balance sheets overnight. What had once been manageable volatility turned into a measurable threat. Risk managers who had relied on gradual adjustment now faced jumps that erased margin in hours. Markets pressed harder. Traders interpreted the move as confirmation that tolerance had limits. The currency became a battleground between credibility and speculation. Each attempt to stabilize without action fed further testing. The gamble had reached a phase where restraint no longer looked like confidence. It looked like indecision. Policymakers moved quickly, but the timing carried cost. Verbal interventions slowed momentum briefly, then faded. When direct action followed, it arrived into a market already conditioned to challenge it. Reserves were used carefully, signaling defense without capitulation. But the signal was mixed. The market sensed protection, not dominance. Volatility surged. Pricing became uneven. Liquidity retreated at key moments, amplifying each move. What had been a strategic choice now dictated behavior across the economy. Borrowers reassessed exposure. Banks tightened terms. Investment paused. The currency gamble spilled into growth, credit, and confidence. Inside Warsaw, the realization was unavoidable. The strategy had altered incentives too deeply to reverse without consequence. What began as a controlled tolerance had encouraged risk-taking that magnified stress once tolerance was questioned. The gamble had not failed in theory. It had failed in practice. As pressure peaked, the cost of restoring control became clear. Intervention would need to be decisive, coordinated, and visible enough to reset expectations. Anything less would invite continued testing. The market was no longer guessing intentions. It was demanding proof. Poland stood at a familiar crossroads in financial history. Adapt and absorb the cost now, or prolong uncertainty and pay more later. The gamble had reached its final stage. And in currency markets, final stages rarely allow graceful exits. The reset came with unmistakable force. Warsaw abandoned ambiguity and acted with clarity, deploying reserves alongside firm policy signals that left little room for interpretation. The message was no longer about tolerance or flexibility. It was about boundaries. The currency would not be allowed to drift into instability, regardless of the short-term cost. Markets reacted immediately. Volatility spiked, then compressed. Traders stepped back, reassessing assumptions that no longer held. The currency stabilized not because pressure disappeared, but because the rules of engagement had changed. Credibility, once questioned, was being reasserted through action rather than explanation. Inside the financial system, adjustments followed swiftly. Banks recalibrated exposure. Corporations accelerated hedging. Borrowing patterns shifted away from foreign currency dependence. The cost was real. Growth slowed. Margins tightened. But the uncertainty that had haunted decisions began to lift. Stability returned, imperfect but defined. The episode left a lasting imprint on policy thinking. Currency management was no longer treated as a background variable. It was recognized as a force that shapes behavior as powerfully as interest rates or regulation. Signals mattered. Timing mattered more. And tolerance, once misunderstood, could invite risk faster than it contained it. Europe absorbed the lesson with familiarity. Currency strategies rarely fail because fundamentals collapse. They fail because incentives drift unchecked. Poland's gamble demonstrated how quickly markets adapt to perceived limits and how expensive it becomes to redraw them once crossed. In the end, control was restored not by denying volatility, but by confronting it directly. The gamble closed with costs paid up front rather than compounded over time. Poland emerged steadier, but changed, more aware of how thin the line is between guidance and gamble. Warsaw's currency gamble did not end in disaster. It ended in clarity. And in financial systems, clarity is often the most valuable asset of all. Subscribe to join the journey. Warsaw